Okay, good morning, everyone. Looks like most people have joined us now, so I'll make a start. Welcome to RSM's Financial Reporting Update 2021. And today we're doing the special not-for-profits edition of the Financial Reporting Update. So welcome to all of you. Thanks for coming today. So my name's Ralph Martin. I'm the National Technical Partner at RSM Australia. And I'm joined by Anna Espinel-Ray, who's our National Technical Senior Manager. And Anna is also a specialist in the not-for-profit area, so I'm very glad she could join us today. Firstly, probably everyone's familiar with Zoom webinars after the last year or two, but just for anyone who isn't, if you do have any questions as we present the event, then please use the Q&A button at the bottom of your screen, the Q&A button. We very much welcome questions. Feel free to ask them at any time during the event, and we'll do our best to try and make sure we answer as many questions as we possibly can. You can either do it anonymously or not anonymously, so don't be shy. So with that introduction, let's talk about what we're going to talk about today, and start with some good news. What we're not going to talk about, if you've been to any of the presentations by myself or anyone else over the last few years, you'll have heard a lot of us spending our time talking about revenue, financial instruments, and leases. And the good news is those standards have all been enforced for a couple of years now, so we're not going to go over them yet again. We're going to move on and talk about some different things. The other thing I'm not going to talk about, is because it's pretty niche and probably doesn't have a lot of relevance in the not-for-profit context, is the new standard on insurance. There's a new standard on insurance contracts. If you are in the insurance industry, this is a big deal for you, but I don't think that applies to anyone attending today, so I'm not going to talk about it. But if you do have questions about it, do feel free to get in touch with me. I'm happy to go through it in detail. So having said what we're not going to talk about, what will we talk about? So the main topic that I'm going to spend most of the time talking about today is really the top two things on the slide here. So there's a new framework for general purpose financial reporting, and it's applicable in both the for-profit and not-for-profit sector. There are also some other changes linked to that are happening to the not-for-profit sector financial reporting framework and financial reporting obligations. So we'll spend probably the next 30 to 40 minutes going through that in some detail. We will then also talk about what the changes are to accounting standards. While there are no major new standards, there are some changes. So I'll spend a little bit of time on that. We'll also finish off by talking about IFRIC agenda decisions, which may not be something you spend a lot of time thinking about, but there are a few agenda decisions there that can have an impact on the not-for-profit entities. So if you're not familiar with what they are or why they're important, don't worry, we'll reveal all over the course of the next hour or so. So I'll start by mentioning reporting deadlines, and I guess good news and bad news here. I'll start with the bad news, which is for ACCC registrants. ACCC registrants, which are most people on this webinar, there are no changes to reporting deadlines for 2021. That's not so much an issue that ACCC do have slightly longer deadlines anyway. But for anyone who isn't ACCC registered, so in the not-for-profit sector, that particularly means any companies limited by guarantee that aren't ACCC registered, what ASIC confirmed is that they will be giving an additional month to everyone. Everyone has an additional month. So that's probably very welcome news. I will say in the listed sector, which probably isn't that relevant, there's no extra time to lodge your unaudited accounts, but in the not-for-profit sector, you do have one extra month. The other thing that may be of interest is the position on AGMs. While this is an ASIC position, I'd say it also equally applies to AGMs for ACCC registrants. And that's that ASIC's confirmed what they call their no action position. Now, the background to this is that when the Corporations Act was originally written back in the late 1990s, Virtual AGMs and virtual meetings weren't really contemplated as a thing at that time. They weren't very common and didn't really exist in any meaningful way. So Corporations Act, from it the derived ACCC legislation, is really silent on whether an annual general meeting has to be a physical meeting or whether it can be held virtually. It's not clear. So what ASIC have said is that they will take no action. And in fact, they encourage entities to hold meetings virtually because it normally allows a greater range of shareholder or member participation. So that's very much allowed and encouraged. The only caveat to that is that it must be a genuine meeting. It can't be a webinar presentation, so it can't be the sort of format we have today. It must be a genuine meeting where members do have a genuine opportunity to interact with and ask meaningful questions of the directors or the committee or whoever those charged with governance are. But if you do that, then yeah, virtual general meetings are very much an allowed thing. And linked to that, there's also a 2-month extension of the deadlines for holding AGMs. Okay, so next thing I wanted to talk about was the change to the financial reporting framework, RDR to SDS. We accountants do love a good acronym. What does that all mean? Well, what I'm going to talk about is a change that initially was targeted primarily in the for-profit sector, but actually does have quite wide applicability to the not-for-profit sector. So bear with me, we will be explaining why all of this is actually going to be quite a big impact on the not-for-profit sector too. And the background to all of this is something we have that's almost unique to Australia called the reporting entity concept. So we have this concept whereby if you're a director or part of those charged with governance and entity and you're preparing your financial statements, you get to decide, am I a reporting entity? In other words, are they users of my accounts that depend on those accounts to make decisions? And users is fairly broadly defined. It doesn't necessarily mean just members or shareholders. It can be lenders, it can be suppliers, it can be employees, it can be donors, it can be providers of grant funding. So are there any users that are using those accounts to make decisions? If there are, you're a reporting entity. You must prepare general purpose financial statements. If they aren't, you're a non-reporting entity and you can prepare special purpose financial statements. Special purpose financial statements, you really have a very wide range of discretion as to what disclosures you include. It can be, I've seen them range from almost the same as full IFRS accounts down to accounting policies, very briefly, and pretty much nothing else. So there's a very wide range of judgment there. The problem with this is that the reporting entity concept does have a bit of a fundamental flaw to it, which is that we're asking directors or management committees to make this decision on who their users are and what they use the accounts for. The problem is if you're a medium or large ACCC registered company, or if you're a large company under the Corporations Act or a company limited by guarantee, you have to lodge accounts on the public record. That means anyone at all in the world who wants to can download them and use them for anything at all that they like. And you won't even know that they've done that. So how can you therefore reasonably make a judgment on whether or not you have dependent users? You don't know who's got your accounts and what purpose they're using them for. So you're really being asked to make an impossible decision. And that's really the fundamental flaw that's been seen as a problem in the Australian financial reporting framework for a while. The other element that has been there has been a view that special purpose financial statements have been abused. Probably not so much in the not-for-profit sector. The focus has probably been on Australian subsidiaries of large multinational corporations that have been lodging special purpose accounts to avoid lodging meaningful accounts about their Australian activities. But what we have at the moment is, so we have 3 tiers of financial reporting. So large entities that are publicly accountable, and that would include large charities, will prepare full IFRS compliant financial statements. For other publicly accountable entities that don't need to do tier 1 but do have dependent users, they would normally prepare reduced disclosure regime or RDR financial statements. And that's generally the case for a lot of sort of mid-sized not-for-profit entities where there are funders or donors looking at the accounts, but they aren't publicly accountable. But most accounts, and this is true in both the for-profit sector and not-for-profit sector, most accounts that are lodged with either ACCC or the ACCC at the moment are special purpose financial reports. So, what's changing? Well, some for-profit entities, and this bit only applies to for-profit entities, are from next year going to have the option to lodge special purpose financial statements removed, taken away from them. I emphasize at the moment, this is only for-profit entities, but if you are a for-profit entity, if you're involved in one of those and they lodge accounts under the Corp Tax, for example, then they will no longer have the option to lodge special purpose financial statements. They will have to do general purpose financial statements. But what will they have to do? Well, what there's going to be is a new simplified disclosure standard, AASB 1060. This replaces the existing RDR. So new simplified STS. And new AASB 1060, first thing to say is it applies to both for-profits and not-for-profits. We will talk in a minute on how it applies to not-for-profits. It's mandatory from 1st of July 2021. That's the effective date. But as we'll talk to the moment, there are some transitional provisions available, which means for affected entities, it may be worthwhile early adopting by a year. It replaces the existing reduced disclosure regime, RDR. So RDR will no longer exist. 30th of June 2022, year ends, RDR will no longer exist. Everyone will have to transition to STS. It is a disclosure standard only. It does not change the recognition and measurement requirements of Australian accounting standards. Disclosure only. So anyone who prepares accounts under STS will have to comply fully with all of the recognition and measurement requirements of Australian accounting standards. There were some entities that lodged special purpose financial statements, in particular, that didn't comply with things like deferred tax, leases, financial instrument requirements in some cases, and particularly not with consolidation and equity accounting. All of that's going to disappear. Last thing to say is AASB 1060 is based on IFRS for SMEs, but it isn't IFRS for SMEs. IFRS for SMEs is an entirely separate financial reporting framework, simplified rules for things like intangible assets, deferred tax, financial instruments. It doesn't exist and is not available in Australia. It's available in some other jurisdictions, UK, South Africa, for example, but not in Australia. So don't get confused between AASB 1060 and IFRS for SMEs. Okay, so let's talk about the impact. At the moment, it is only for-profit entities that are potentially going to lose the ability to prepare special purpose financial statements. For the moment, not-for-profit entities, if you are a non-reporting entity, you will retain the ability to prepare special purpose financial statements and lodge them with ACCC or with ACCC. So the big impact in the not-for-profit sector for this year is probably that third category there. If you are currently preparing reduced disclosure regime accounts, then you will have to transition to STS. The drop dead date is 2022, 30th of June 2022, but we'll explain in a moment why you might want to do it for 30th of June 2021. If you are preparing reduced disclosure regime accounts at the moment, there's good news and bad news. The good news is that overall, the new SDS generally has less disclosures than RDR. And we put some examples here on the slide of the key disclosures that get removed. Revenue and discontinued operations are two, but probably the biggest one I'd highlight is financial instruments, particularly for those not-for-profits that are fortunate enough to have investment portfolios or endowments or anything like that. The detailed disclosures around measurement basis and also around loss allowances and impairments can be quite time-consuming, and they are removed on they are required under RDR, but will be removed under SDS. On the other hand, there are some disclosures going back in. Probably the big two I'd highlight: audit fees, relatively straightforward. But the big one I'd highlight in the not-for-profit sector, firstly, the leases, the maturity analysis. If you have leases, that can be quite time-consuming, particularly if you have multiple leases. And also in the government sector, disclosure of parent and subsidiary relationships by government-related entities. That may be challenging for those specific entities that are affected. But overall, if you are transitioning from RDR to SDS, it's probably mostly good news, and mostly there is a reduction in disclosure required. However, if you are a not-for-profit and you are continuing to prepare special purpose financial statements, which you are allowed to do, there are some additional disclosures that are required. Now, these aren't new, they were actually required last year, and in our experience, often weren't done that well, which is why we're highlighting them here. So key things I'd highlight there is, firstly, why have you prepared special purpose financial statements? And that's a matter of going back to the reporting entity concept and explaining why you don't believe you think you have dependent users. And that could be a good prompt to really think carefully about whether you are in fact a reporting entity or not, because a lot of not-for-profit entities have some measure of public interest and public accountability, even if you're a relatively small organization. There can be donors, there can be governments, there can be grant funders that are all quite interested in accountability and transparency, and looking at the financial report is an important part of that. But if you've gone through all of that and you still believe you're a non-reporting entity, you do have to disclose why. The other things you have to disclose is consolidation and equity accounting, whether you're applying those rules, and if not, why not? And also, both on an individual accounting policy level and an overall level, we should be talking about each material accounting policy, whether and how it does or doesn't comply with the requirements of Australian accounting standards. So whether you actually comply with the recognition measurement requirements of Australian accounting standards in full. So some additional disclosures there to be aware of if you are in the not-for-profit sector and preparing special purpose financial statements. Now, there are some transitional provisions. So if you are going to prepare SDS financial statements for the first time, it may well be worth doing it this year rather than waiting until 2022. The reason I say that is the bottom half of that slide there. If you early adopt by a year, then you get relief from restating comparative information if there are changes to recognition measurement. And also if there are changes to disclosure, you have relief from providing comparative information for any new disclosures. So that's why I say that if you are affected by this, in most cases, we're saying probably is worth early adopting by a year, because otherwise things will get challenged in 2022. You'll have to go back and start redoing disclosures for last year and working out all the information from that. Makes it a much smoother process if you adopt it for 30th of June 2021. Okay, so I've covered the new reporting framework. I've covered this relatively briefly and in quite a high level of detail. If you would like to know more, then a bit of self-promotion here. Do go and read our article on the website. We put an article, I've put the link there, so it's on the slide, but don't feel you have to write down the URL. We will send a follow-up email around that will have both the slides and a link to the article so that you can go and read it, or you can Google it. It's up on the RSM website. but it goes through in a little more detail the changes and the exact detail of who's affected and the changes to disclosure as a result of the introduction of STS. Okay, just a reminder at this point, the Q&A box is open. If you do have any questions about anything we're covering, feel free to write it, and we'll do our best to answer all of your questions. But I'm now going to hand over to Anna, who's going to talk through the changes to the not-for-profit financial reporting framework.
Thanks, Ralph. So, yes, all the background that we've given, mostly there's been a change in the framework for for-profit entities. Not-for-profit entities, there is an ongoing process where in which not-for-profit entities report is being reevaluated. And the background for this is really from the ACCC legislation review and I know 2018 sounds like ages ago, it was before a certain pandemic, and yet these things take time to make their way through Parliament. So basically a report, a panel was set up to report back to Treasury how the ACCC Act was doing, basically 5 years after its initial impact, to evaluate whether the ACCC was actually effective. It's quite broad in scope. It didn't really focus on financial reporting, but financial reporting was very much part of it. And so last year in 2020, the initial reports were published with findings from this review. And there were three main things that came out of the review. The first one was the view that the current revenue thresholds to determine whether an entity is large, a charity is large, or medium or small, are too low. The second point was that accounts that were lodged really did not have enough information disclosed around related party transactions. That's particularly concerning for charities and for not-for-profit entities, because there's a concern there that charitable assets are used for private benefits. So if you're not having to disclose related party transactions, you don't have to disclose close family members who are employed in positions that perhaps they're not quite ready for, or even more genuine arm's length related party transactions, so where the best supplier to provide a service is a related party of the entity. If those aren't disclosed, then there's not really enough information for users to actually review how the charity or how the not-for-profit is actually using their funds. And so really there was not enough disclosure found in that context. And the other part was that because it's linked with related party transactions and related party transaction disclosures, there weren't either any remuneration disclosures made in many of the accounts, or if they were not enough. And so again, it really minimizes the public accountability part, and considering that charities get money from a whole range of funds, that was seen as an area of concern. The area of focus and the reason that there's been a bit of a delay in making changes to financial reporting frameworks that apply to not-for-profit entities is because the recommendations that were made partially said, okay, we're looking to change the thresholds that make an entity small, medium, or large. So we're actually looking at going not only from, say, entities over 1 million with turnover, revenue over $1 million are large. We're going from 1 million to 5 million. But we're actually not even going to look at 1 year. We're thinking, instead of looking at 1 year and saying, is your income more than $1 million? You are therefore large. We're looking at a 3-year rolling basis. What is actually the average income over that 3-year period? So obviously you'll notice in this table, we're looking at significantly increasing the thresholds, so multiplying them by 4 or by 5, but also looking at a different time range to determine that threshold. So that was a recommendation that was made. The two other recommendations that basically sought to address the two other findings, which was, okay, well, simple thing, we can actually require not-for-profit entities to disclose related party transactions, and we can require at least large entities to disclose remuneration paid to responsible persons. Even if we do it on an aggregated basis, that will already be more than what's currently required, which is nothing. So after these recommendations were made, the government eventually published their response in March last year. And they said, yeah, this sounds great, but we're going to hold fire on actually doing anything about the changes in thresholds because we actually have to consult. We have to consult with states, territories on what is actually an appropriate level. Is it 5 million? Is it 3 million? Is it something else? We're not sure. And related to that, if we change the thresholds, do we have to actually think about new tiers of financial reporting? So when Ralph mentioned earlier, there are 3 tiers of financial reporting, with tier 1 entities doing like tier 1 preparing general purpose full IFRS compliant accounts, tier 2 preparing SDS accounts, tier 3, this kind of notion of tier 3 being special purpose financial reporting framework. That isn't really how it works in the not-for-profit sector. So in the not-for-profit sector, if I just go back one slide, if you are a large company, you have certain requirements. If you're medium, you have certain reporting requirements. If you're small, you have other requirements. And currently, even if you are large, you still have a choice based on that reporting entity concept of which type of financial statement you actually prepare. Most of the time, if you are extra large, for lack of a better word, although that's not actually clearly defined, extra large not-for-profits will end up preparing full IFRS compliant general purpose financial statements. But if you are a large not-for-profit and actually think you are a non-reporting entity and can support that, notwithstanding the potentially contradictory view that Ralph mentioned earlier, that you are being asked to report, so perhaps you are actually a reporting entity. But if management take the view they are not a reporting entity, even though they are large, they are still able to prepare special purpose financial statements. And so that is what is being looked at as a change. So they're thinking, okay, well, maybe we require large companies to prepare a specific type of financial statement. Maybe we require medium entities to prepare at least a specific type of financial statement. That might be SDS, and so on. And maybe what they're debating is, do they need 3 tiers, 4 tiers? What do they look like? And so really, things in the accounting standards world happen kind of slowly until they suddenly seem to happen at once. So what's happening is, at the moment, there are targeted consultations that are taking place, trying to find out what actually would work for stakeholders. And the AASB, the board themselves, are having deliberations around what this new financial reporting framework could look like. There was an AASB board meeting earlier this week, and I can definitely vouch that the deliberations are very much ongoing. But the objective is that by the end of this year, they will issue a consultation paper for public comment by the end of the year. So that will give us a bit more insight into what they're currently thinking. The key, though, is that this is not anywhere near being finalized. So there's not actually going to be a new financial reporting framework for not-for-profits until, I'd say, 2023, 2025, somewhere in there. I am very much not a gambler, but if I were a gambling person, I would probably say special purpose financial reports will disappear for not-for-profits as an outcome of this, for large not-for-profits at least. But that is just very much my feeling. It's not actually fact. But obviously we'll keep everybody posted as we find out more in terms of where the AASB is heading.
Yeah, I'd echo that. I think the reason the abolition of special purpose financial statements was delayed for not-for-profits, was essentially that AASB want to line up the increase of the small and medium thresholds with the abolition of special purpose. Otherwise, you potentially have a situation where entities with over $250,000 of turnover, so really very small entities, are having to prepare general purpose financial statements, and that was seen as a bit inequitable.
So meanwhile, we've talked about revenue thresholds, which obviously leads to the topic of interest in the not-for-profit sector, which, although we said we weren't going to touch on AASB 15, is very worthwhile talking about in the context of not-for-profit entities. So when we're talking about revenue and income, this impacts, obviously, figuring out whether you're large or small, but also impacts generally in your financial reporting are the 2 revenue standards, or revenue and income standards, which have applied for not-for-profit entities now for a year and a bit. This is the 2nd year. And the question, really, having had this year of implementation and thinking about what works and what hasn't worked, is that really there's still 2 main matters that stand out as perhaps having problems. The main issue really is around the point of this concept of a performance obligation. So by way of background, just to make sure we're all on the same page, the way that the standards work together, just again to make sure that we're all happy, is standards say for any income that you receive, you have to evaluate whether you receive it in a contract with a customer, with the customer being, basically, is it an enforceable contract, and your customer will be the person funding you. If you receive income under an enforceable contract, the next question is, are there sufficiently specific performance obligations in this contract? Now that is really a key question, because if there are not, then you end up having to recognize income under WSB 1058, which usually means you end up recognizing income on receipt. I appreciate that is not strict wording of the standard, but in practice, that is how we see it work. And so really, because of that issue, because especially government grant funding in particular is given under agreements that are worded in ways that should create an enforceable relationship between the not-for-profit and the funder, the main question that then entities end up having to ask themselves is, are there sufficiently specific performance obligations in this grant agreement for me to be able to recognize income under WSB 15? The benefit of doing that is that there's potentially scope for recognizing revenue over time under WSB 15, although again, there do have to be certain criteria in addition that are met. It's not an automatic thing, so it isn't just WSB 15 applies, and therefore we recognize revenue over time. However, there's the possibility there to maybe get to that conclusion. But identifying, firstly, that there are performance obligations, and then that those performance obligations are actually sufficiently specific, and I'm using air quotes because I'm quoting the standard, but also acknowledging that actually it seems like a very judgmental area, has been problematic. The other area that we'll touch on is just looking at some clauses that have been brought to light, I'd say more regularly in the past 18 months, which are terminations for convenience clauses, which aren't new clauses. They've always been in government grants in particular, but they've maybe come to the front of people's minds when trying to determine how to recognize revenue or how to evaluate a contract, perhaps because contracts have been looked at more carefully or in more detail than previously, and perhaps for other reasons, and we'll touch on that shortly. As I go through this, just a reminder that obviously we're talking about 1058 and 15 because WSB 120 does not apply for not-for-profit entities. So if I think about what really the practical issues are with accounting for government grants under the current standards as they are worded, is that often a not-for-profit will obviously apply for funding and submit a proposal and say, with this funding that I'm applying for, I would like to carry out all of these activities. These all support my charitable objectives, and I will only use the money that you grant me for this purpose. To carry out these general activities or even specific activities, but they're very much activities that will benefit my organization and the users of my organization, because I will obviously be carrying out my charitable purpose. The problem is, if those proposals and therefore the grant agreement itself only includes details of activities that an entity has to undertake to achieve a specific outcome, carrying out specific activities is not a performance obligation. Similarly, saying I'm applying for funding because I want to achieve a specific objective, or I have the goal of, for example, I want to increase literacy in a particular community. Please give me money and I will then use it as I see fit to achieve that objective. Although that is a specific objective that is being funded, that is not a performance obligation. On the other hand, if there are specific contracted outputs and you can read the contract much more in a way that you would if you were being engaged as a contractor, effectively. So you are contracted to deliver specific outputs, whether back to the funder or to beneficiaries, third-party beneficiaries, then that may be a performance obligation. The question then is that performance obligation sufficiently specific? Can you identify when you have completed it? And what we find is that what this means is that there's a lot of work that ends up being involved in looking through contracts, through grant agreements, to see if they will fit into this framework. When you have applied for grants in the past and on an ongoing basis, you might not have thought to word the objectives of the grant in a way that makes it clear what the specific outputs are that would be being funded by the grant being received. And so for two grants that maybe have similar objectives, depending on how they're worded, you might end up with different conclusions in terms of the accounting. You might end up with one grant that has specific contracted outputs, and one that does not, even though fundamentally they feel the same. And so you might end up with different accounting outcomes. So we think that's a bit of a problem. We don't think that's really internally consistent. And we'll touch a bit on that shortly. Because really what we're saying is that in practice, government grants are often given for specific purposes, for restricted purposes. You are only allowed to use the money that you receive for specific purposes. And so the problem is that the purpose or a restriction on use is not a performance obligation. And so what that means is that you end up in the position where you have to recognize income under AASB 1058. And if it is a multi-year grant and you receive funding upfront, or even if it is a year-long grant and you just happen to receive money in June, at the end of June, instead of on the 1st of July, it means you end up having to recognize income in a different year to the year in which you will incur expenditure in carrying out those activities. So to illustrate, for example, if we have an entity which provides counselling and emergency accommodation support for victims of domestic violence, that entity applies for a government grant of $480,000. The funding will be used for 3 years to fund 2 additional counsellors to fund their wages for 3 years. That will obviously enable that entity to deliver on its charitable objectives. And the question then is, well, is there a performance obligation if we assume that contractually, in its legal form, the grant would be enforceable if there were performance obligations? Well, the issue here, for example, is that employing 2 counsellors isn't a performance obligation as defined under AASB 15. And that there is one of the key issues, that understanding of a performance obligation. That has to be a transfer of a service or a good. The fact that you are only able to use those funds to pay certain salaries means that, yes, it is a restricted use of funds, but really in the absence of any other facts, there's no performance obligation, let alone anything sufficiently specific. So if the payment terms of the grant are that you receive $480,000 upfront in year 1, then you recognise all of that in year 1, which means you end up with a bit of a mismatch, or quite a big mismatch, where you have the full income in year 1 and then the expenses over 3 years. The solution as to what to do is obviously not to just disregard the standard, but applying the standard as it's written. The answer is really adding additional disclosure. Add disclosure on the restrictions of funding, perhaps create a restricted reserve for those funds. And by that, I mean literally present a separate restricted reserve in your financial statements that explains the terms of that funding. This is part of a broader conversation around really the use of a surplus or deficit as actually a key measure that users of not-for-profit entities' financial statements, the key being in the word, maybe shouldn't be looking at the surplus or the deficit. But knowing that currently users do gravitate towards that bottom line, still adding as much as you can of a narrative story around what's happened is what will make it easier for your users. Some entities have cottoned on to the fact that there is, in government grants, termination for convenience clauses. Now, these are not new clauses, as I mentioned earlier, but they're clauses that basically say that the Commonwealth may at any time provide notice to the recipient to terminate the contract. And if they do that, it says the Commonwealth is either not liable for any further costs and actually sometimes will demand a repayment of the funding that has not yet been spent in accordance with the grant terms. And so that clause sounds quite enticing because really, although the reason for inclusion of those clauses is really to just enable the Commonwealth to terminate an agreement in the event of a change of government or a change in policy priorities. And the fact that that clause has to be exercised in good faith, some entities have seen this clause as an opportunity to go, okay, well, if there's a clause that requires me to refund money in the event of something happening over which I have no control, then that sounds like maybe it's a liability. But the question to ask is really whether the simple inclusion of a clause in a contract that says, this may happen, it only can happen in good faith, but it may happen at any point, and if it happens, you have no control over it. Does that create of itself an obligation? Or would it only be an obligation at the point that the Commonwealth says, I have now chosen to terminate this agreement? I have my own personal views, but the key fact is there's a diversity in interpretation. And the AASB recently, I say recently, in the past sort of 8 months or so, considered this area in a board meeting. And unhelpfully, they didn't actually indicate which answer was the right one. But what they said is, actually, look, there's judgment required. There's guidance in the standards that you can look to determine, based on your specific facts and circumstances, whether you do have a liability or not. But they highlighted that if you do recognize a liability on day one, what you are recognizing is a financial liability. And so if you recognize a financial liability, you're recognizing it under AASB 9, not under 15 or 1058. And so you have to actually make sure that you comply with the requirements of AASB 9, which is the inordinately long standard on financial instruments. But some entities have thought, well, okay, that might be a way of allowing me to do more of this matching idea. So I would encourage you to read the specific clause in your specific agreements very carefully, if there is such a clause, and to consider really how you best think the standards apply to that grant, rather than automatically by default going, as soon as that clause is in this agreement, I will recognize it in a specific way. And I would also then encourage you to consider whether you are changing your accounting policy if you have previously had those clauses in contracts and not accounted for them in that same way. So all of this highlights really this question that maybe a lot of you have wondered, which is AASB 1058 actually fit for purpose? Does it actually get users very user-friendly accounts? Does it give answers, and does it allow for not-for-profits to present their results in a way that actually sounds true and fair? And the truth is, there's been a lot of negative feedback. And if you have any feedback that you would like to share with us, please do, because we're currently working with CNZ and we're liaising with the AASB, feeding back on experience and specific examples that we've seen where we end up with these counterintuitive conclusions. We're trying to basically argue for a standard that would help users and not-for-profits better reflect the economic substance of transactions that they enter into. So I'd say watch this space, but I would definitely say that if you want to contribute to the body of evidence that we're trying to gather to support this change, please do get in touch with us. When we circulate all the slides and the like after this webinar, there'll be our contact details, so please do get in touch with us to let us know your thoughts, and we can very much add them to this body of evidence we're gathering. There's only one thing that's to do with the not-for-profit sector before we move on to the other interesting parts, but I'll hand back to Ralph, who can just cover it very briefly.
Yeah, thanks, Anna. The last not-for-profit specific thing I wanted to cover was AASB 1059 on service concession arrangements. Now, I'll only cover this at a relatively high level because it's a fairly niche thing, in that what it actually affects is public sector and government entities that enter into service concessions. Service concession is generally when you take a large infrastructure type asset and hand it over to an operator and say, there you go, Mr. Operator, you deal with the running, the maintenance, the revenue collection, everything from this specific asset for a set period of time. I will concede you the service during that time, and in return you pay me a fee. And it might be a big upfront fee, or it might be an annual fee. So the best way to explain this is by way of an example, and this is an actual real-life example we've seen in a number of instances, which is where a university takes one of their accommodation blocks and hands it over to an operator who will deal with the running, the maintenance, the management, all the repairs. They'll collect the actual accommodation fees from the students, and in return they pay a fee to the university. And that's a service concession arrangement. Now, the way it works is that when the university does that, they have to recognize two things. They recognize a service concession asset in respect of the future payments that they will receive for this service concession arrangement, and the corresponding liability. So service concession asset, the value of the asset, the corresponding liability. And those things are recognized on day one, and then they are amortized gradually over the entire period of the service concession arrangement. Now, I've explained that at a very high level. It is quite a technical standard, so if you are caught by it, do come and talk to us. We're happy to go through it in more detail, but for this purpose, I just wanted everyone to be aware that that's out there. And there is now a standard in an area where previously there was nothing. So there were all sorts of accounting policies being adopted for these types of contracts. Okay, next thing I want to talk about is the upcoming changes to accounting standards, because while there's no new major standards this year, there are a couple of changes to existing standards which are worth highlighting. First one, you might remember I said at the start we're not going to talk about leases mostly. This was the reason for the mostly, in that there is something we do need to mention, which is the IFRS 16 COVID concessions, the amendment to the standard for that. Now, the way this works is, let's say I have some premises, but as a result of COVID, I either have to cease operating from those premises for a while, or I have a very, very reduced volume of activity in those premises. So I go to my landlord and I've negotiated a rent concession. They're going to reduce the rent for a period. Let's say they're going to reduce my rent by 70% and they're going to do that for 6 months. Under the existing IFRS 16 as written, what the standard would say is that's a lease modification. That's a modification to the terms of your lease. And the way you would account for that is effectively recalculate your lease liability and your right of use asset. And therefore, the effect on your income statement will be spread over the entire remaining lease term. You have 20 years left on your lease. The effect of that rent concession will be spread over 20 years. Now, 2 issues with that. One is that recalculating all of your leases is quite complex and fiddly, especially if you've got a lot of rent concessions. The second is you're left with a situation where you're getting the negative impact on your profit or loss immediately, but the reduction in your rent happening over 20 years. So while matching isn't technically a concept in accounts, in my view, there is an element of truth and fairness for users in those 2 things occurring at the same time. So what the IASB said is, okay, understand all of that. So for COVID-related rent concessions, and I emphasize it is only for COVID-related rent concessions, you get a rent concession for flood, bushfires, natural disaster, or any other reason that's not COVID, none of this applies. But for COVID-related rent concessions, you can account for it as a variable lease payment. And what that is a fancy way of saying you can just recognize it as a credit to your income statement in the period that you actually get the rent concession. Now, initially, when they did that, they said in order for that to apply, it can only be for rent concessions up to 30th of June 2021. However, as COVID has suddenly gone on and on and on, and there's still very much going on in New South Wales at the moment, the IASB has extended that, and they've now said it's for any concessions up to 30th of June 2022. So if you have negotiated or you are negotiating a COVID-related rent concession, that is potentially good news for you. The one slight twist to that was if you had a rent concession last year that went on beyond June 2021, you would already have accounted for it as a lease modification. So if you were to try and adopt this, you would have to go back and restate your accounts. But I would emphasize this is an optional concession. You don't have to apply it if you don't want to. So I've covered that relatively quickly, but if you go to our website, the link's there. There's an article that Emma and I have put together that actually goes through that in a lot more detail and has about 6 or 7 worked examples of rent concessions and lease modifications. So you can have a look at exactly how the double entries look for that. So do feel free to go on our website and download that. Next thing that's changed is the definition of a business. Now this does have application in the not-for-profit sector, particularly when we have not-for-profit entities that merge operations, which we've seen quite a few over the last few years. Either entities just 2 small entities deciding they're better off merging, or we've seen cases where lots of state-based entities have merged into a single national entity. the key here is the change to the definition of a business, which might sound like quite a techie thing, but can actually have a big impact on the accounting. The reason it has a big impact on the accounting is that where you acquire a business, it can be acquired by acquisition, acquired by merger, or acquired for zero consideration, reasonably common in the not-for-profit sector. All of those fall potentially within the standard. Where you acquire a business, you have to do business combination accounting under IFRS 3. So that means you have to fair value all of the assets and liabilities you acquire. You then have to go and work out, are there any unidentified intangible assets? That can be things like licenses, intellectual property, software, even things like customer contracts and customer relationships. Work out all of that, then work out the difference between the consideration paid and the assets acquired, and the difference goes to goodwill. So that can be a lot of work. If on the other hand, you just require some assets that don't meet the definition of business, then like any assets, you just recognize them at cost initially. So the initial accounting, at least, is much simpler. So it matters a lot whether you're a business or not, whether you acquire a business or a collection of assets. And what determines that is whether you meet the definition of a business. And to be a business, you have to have inputs and processes that can be used to create outputs. So inputs are economic resources. It can be staff, it can be intellectual property, it can be physical goods. The processes is where you do something to those inputs. So you don't just hold them, you don't just do something, you actually do something to them. And that can be having people to manage and monitor and maintain them. It can be a manufacturing process in the service context. It can be having staff who facilitate the delivery and organize the delivery of those inputs. But if you have those two things, they can be used to create outputs. You have a business. Now, that all sounds very theoretical, but let's look at a practical example. If I acquire some real estate, if I acquire some properties, in this example, I acquire a property company, but all I'm acquiring actually is 10 houses. All of those houses have 10 tenants in place, so all I'm acquiring is those 10 houses. There's no employees, there's no assets, no other processes. And that would not be a business. That would not meet the definition of business. So I just work out what I paid for this and then divide the cost by 10 and allocate it to those 10 houses that I put on my asset register. What about though, if I acquired the same thing, except it's now a corporate office park with multi-tenant corporate offices, and as well as the land, buildings and leases, there are also contracts there. Things like cleaning, maintenance, repairs, security and so on. And there's an office on site that I'm acquiring with employees that does things like tenant management, contract management, and so on. Those things are processes. So now I've got inputs in the buildings, and I've got processes, which means I've acquired a business, which means I'm going to have to go and work out the fair value of all those buildings I acquired, work out what I paid, and any difference between the two would be goodwill. That's important because once I have goodwill, I have to test it every year for impairment, potentially quite onerous going forward. Okay, so that's the change in AASB 3. It's already effective and why it's important. The other key change to accounting standards is about the classification of liabilities. And this was presented by the IASB as a clarifying change, but I'm not sure it is, and I'll explain why. The key principle here, and the key principle hasn't changed, is to classify any liabilities non-current. There must be an unconditional contractual right to defer settlement for at least 12 months. Unconditional contractual right. So note here that intention and probability doesn't matter. If I've had a bank loan for the last 20 years, it's due for renewal within the next 6 months, then it's current. Even if the bank's renewed it every year for the last 20 years and they're 99.99% likely to renew it again, doesn't matter. If at the balance sheet date, it's due for renewal within 12 months, it's current. Similarly, if I have some some debt that's due for repayment in 5 years' time, it's non-current. Even if I'm expecting a big windfall, I'm probably going to repay it in the next 3 months. Doesn't matter. If contractually it's only due for repayment in 5 years' time, I must classify it as non-current. So that's the key to the requirement of WSB 101 here. The unconditional contractual right to defer settlement is what's important. What's been clarified is what is meant by right to defer settlement. The two things that have been clarified here is firstly that the right to defer settlement must exist at the balance sheet date. So if my year ends 30th of June, and at the 30th of June, my debt was due for renewal within the next month, must be current. Doesn't matter if on 2nd of July that I agreed with the bank that we would renew it for another 5-year term. That doesn't matter. If that's 30th of June, that agreement wasn't signed, then the debt is current. And that's also the case when you look at things like lending covenants and compliance with them. You must be in compliance as at the balance sheet date. If you're not, then it's current, even if that non-compliance was only tested and determined at a later date, by which time it's already rectified. Last thing that changes is the definition of settlement. So settlement, a lot of people used to interpret it just as cash settlement, but it now means if you have potentially contractual obligation to settle in cash, or in goods or services, or in shares, unless that's a conversion option that was initially classified as equity, then it's current. So the ISB said that this is clarifying only, and they don't expect it to be a significant impact. I don't necessarily agree, particularly because when entities have convertible debt, and that convertible debt has a conversion option whereby the holder can convert it to shares at any time, then potentially they now have to classify that as current, even if they don't have an obligation to pay cash for more than 1 year. They have an obligation potentially to issue shares within 1 year, then it would be current, unless it was initially classified as equity, which would mean it met what's called the fixed test inception. I won't go into too much detail about that because that's probably limited relevance in that profit sector. But if you are unsure about that, then do go and read the RSM Guide to Convertible Debt on the RSM Australia website, which is an excellent guide to convertible debt. I know it's excellent because I wrote it. So do go and have a read of that. Okay, last thing I wanted to talk about was IFRIC agenda decisions. And unless you're a technical nerd like me and Anna, you probably don't think spend a lot of your time thinking about IFRIC agenda decisions. You may never think about them. You may never have read one. You may never even have heard of one. So why are they important? Well, the way accounting standards are set and the way they work is what you have is the International Accounting Standards Board that sets the standards. Supporting that is the International Financial Reporting Interpretations Committee, the IFRIC. And what the Interpretations Committee does is it receives queries, and anyone at all can send in a query to the IFRIC, anyone at all. And it receives queries that say, we believe there's an area of inconsistency in IFRS. There's this problem, it's not clear how to treat it under IFRS. What do you think we should do, IFRIC? And what they do is they sit down and they consider it, and they come to one of 4 options. One is that they can issue an interpretation to say, yes, it was unclear, here's our interpretation of how to treat it, it's now clear. The interpretations are all there on the Accounting Standards Board website, but there aren't any new ones this year, which is why I haven't mentioned them yet. So they can do that. They can recommend to the board that there's a problem with the existing standards. It should be settled either by changing the standard or by writing an entirely new standard. Or what they can do is say, we're not going to take this onto our agenda because we think under IFRS the treatment is already clear, and here's what it is, here's the answer. So IFRIC agenda decisions are what I call semi-authoritative pronouncements. They don't have force of law in the same way accounting standards do, but they are things you need to be aware of because they are considered, I guess, pronouncements of an authoritative body on IFRS accounting standards. So really, if they affect you, you do have to comply with them. And the first one that was issued was the one on cloud computing. Now, the background to this is that the existing standard on intangible assets was written when software was a thing that sat on your computer or on your server. And the way you bought software was you either bought a physical CD and went and installed that, or you downloaded it from the internet and it sat on your computer on your server. It was under your control, and you could then go and modify, customize, tailor it to your heart's content, and that was now set under your control. But nowadays, a lot of software arrangements are actually software as a service arrangements where you don't own, download, control the software. The software sits up in the cloud, where it's all controlled, managed, maintained by the software provider, and you have access to it to do whatever the software does. You upload your data or whatever it is, and use the software to do whatever it does. So the question was, in that situation, how should I treat customization and configuration costs of cloud software where I don't control the software? Can it be an intangible asset? And the answer the IFRIC came to was no, it can't. So if you spend a lot of money on customizing and configuring cloud software, it's not an intangible asset. What it might be is a prepayment, but I only say might be, because what that depends on is the extent to which software customization and configuration is a standalone asset, or whether it's an integral part of the underlying software. If it's a standalone service that you're receiving, then like any service, you would recognize the expense when you receive that service. So when the customization and configuration is done. So effectively, you'd expense it immediately. You'd expense the cost immediately. If it's an integral part of the cloud software, then effectively what you're doing when paying for the customization and configuration is making a prepayment for your software license. You're making a prepayment. So you would capitalize it as a prepayment and then amortize it over the term of the software license. Now, which of those two approaches you take depends on whether the customization and configuration is distinct. And in order to work out whether it's distinct or not, what you actually need to do is go and look at the revenue standard, which has some guidance and definitions in there of distinct. So I highlight that because it's not an intuitive thing to do. We're talking about how to recognize an expense, software expense, and whether it's an intangible asset or not. And the IFRIC is saying, go and look at some guidance in the revenue standard, not a place you'd think to look. But now you know about it because I've told you, so you will have to go and look and see whether your customization and configuration costs are distinct and therefore whether they can be capitalized as a prepayment. The key thing here is they cannot be classified as an intangible asset, which was fairly common practice before this IFRIC interpretation came out. Okay, I'll just talk about a couple more of these at the end of our hour now. First one I wanted to mention was reverse factoring. Now, everyone's probably familiar with debt factoring, where you have some trade receivables and you basically hand them over to the bank. So you will collect these for me and you just give me the money all up front, and the bank does that, and they obviously charge a fee. They give you a discount on the value of the trade receivables. That's normal factoring. What about reverse factoring? What that is where you have some trade payables and you say to the bank, go and pay all my trade payables, please, and I'll pay you back all the money at a later date. And obviously the bank will go and do that, and then you'll pay them back the money at a later date, and obviously they'll charge a fee and interest for that service. The question was, when you reverse factor like that, can you still classify it as trade payables, or does it become a bank loan? And the answer was fairly clear, it becomes a bank loan. It's a form of financing, it becomes a bank loan, that's how you present it, that's how you classify it, and therefore importantly, that's how it would be shown in your IFRS 7 disclosures around liquidity risk and credit risk. You would show it as a bank loan if you have reverse factoring. Let's last skip over because that was rather than not for profit. I'll just finish with this one, which probably isn't relevant to anyone, but I think it's really interesting, so I'll talk about it anyway, which is football transfers. So for anyone who's a soccer fan, you imagine, Manchester City or whoever goes and buys Cristiano Ronaldo for $100 million. How do they account for that? Well, that's actually the acquisition of an intangible asset. The player is an intangible asset because you're not buying the physical player, you're buying his contract right. That's an intangible asset. So you capitalize it and amortize it over the term of that player's contract. Then, like any other intangible asset, you would have to assess it for impairment. So if you're like me, or you're a follower of Bristol City, and you watched how they've played this season, I think they finished 19th in the league, and I can say confidently, I think their intangible assets are fully impaired based on how well their players played. But yeah, it's an interesting little impairment assessment now. But the question to me wasn't about that. It was to say, so when I sell a player, how is that treated? Is it revenue or is it disposed of an intangible asset? And the reason that's a big deal is that most of the soccer leagues in Europe have what they call financial fair play rules, where you're only allowed to spend up to a certain percentage of your revenue on wages. So whether your transfer fee income is treated as revenue or not actually significantly affects which players you can buy and how much you can pay them. And what the IFRIC concluded was that sales of players cannot be treated as revenue. They are profit on the disposal of an intangible asset. They're not revenue. So a good example of how what's actually a seemingly very obscure accounting interpretation is actually going to have a big real life impact on the behavior and the operation of the football transfer market in Europe. So a good example of why it is sometimes worth being on top of IFRIC agenda decisions and the ones that affect you. Okay, that's everything we had to talk about. So thank you very much. We'll leave the Q&A open for a couple of minutes for any further questions. Just wanted to address one question that came through, which is about the material from this webinar. So we are recording this webinar for posterity. We will be putting it up. We normally put them up on YouTube and also on the RSM website. And we will also be sending out a follow-up email that will have both a link to the recording. It'll also have the slides and it'll have the link to the articles that we've highlighted during the presentation. So all of that will be available, and do feel free to share it with any colleagues or contacts you think that might be interested in what we had to say. Other than that, I haven't seen any further questions come through. So thank you very much for your participation and your attendance today. We just have had a question come through. So what's your recommendation to not-for-profits for a change from special purpose financial statements to RDR this year? Good question. And I'm going to slightly dodge this and say, I think the answer depends. Firstly, I think if you are currently preparing RDR financial statements this year, I would transition to SDS this year. I would transition to SDS this year. If you're preparing special purpose, then you're not under any obligation to do anything, and it's probably worth sort of not doing anything until the financial reporting framework is clarified, as long as you are satisfied that you are genuinely able to prepare special purpose financial statements. And I think the ACCC is looking, particularly for some of the bigger charities, at that quite closely, because where you have multiple stakeholders, government grants, donors, and so on, you probably should consider yourself a reporting entity. Anna, did you have anything you wanted to add to that?
No, that would be what I would add. Yeah, that we wouldn't recommend a blanket definitely prepare SDS accounts, but if you're currently preparing special purpose financial statements and you believe that actually you are a reporting entity, in that case, we would be advising to do SDS accounts rather than RDR. It just saves you a step. But yeah.
Okay. Well, thank you very much for the question. Don't see any further questions. So thank you very much for your attendance today, everyone. And if you do have any questions at a later date, do feel free to get in touch with Anna and myself. We'd be very happy to talk to you. But otherwise, hope you've enjoyed the webinar, and goodbye.